Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today is another AMA episode, that is, Ask Me Anything. I love to answer your questions, and if you have a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. On today's show, Dominic asks, Dear Victor, thank you for the ongoing excellent content. While awaiting projects to invest in that make sense to me, I've been looking at various places to hold capital. Do you have any thoughts regarding the infinite banking concept using whole life insurance policies as a collateralized asset? The pitch seems to be that these policies provide a tool to park unused funds with some dividends. When a suitable investment comes along, the insured borrows from the insurance company with the cash value acting as the collateral. The pitch being your money is working in two places, earning dividends within the policy while also being deployed in a higher return investment. Other advantages being potential tax advantages on accrued values, some asset protection as insurance policies may be exempt from some collection actions, and generational wealth transfer. In concept, this seems to me to be similar to leveraging collateral of other assets such as real property, precious metals, and so on. I'd be interested to hear if you have any thoughts on the utility of this. Well, Dominic, this is a great question. Now, let me preface my comments by saying that your question gets to the heart of personal philosophy around money and how to best invest. It's a little bit like asking whether the image on the magazine cover is beautiful. It's a little bit in the eye of the beholder. Now, I personally am not a fan of life insurance policies in general, but that's just me. Remember, life insurance companies make a profit, and there's no free lunch. When you borrow against your life insurance policy, it's my understanding that the value of the policy is reduced by the amount you have borrowed. You are correct. Borrowing from your life insurance policy can be a quick and easy way to get cash in hand when you need it. You can only borrow against a permanent or whole life policy. Policy loans are borrowed against the death benefit, and the insurance company uses the policy as the collateral for the loan. You got to read the fine print. Some policies penalize you more than just the money borrowed. Those who advocate life insurance as an investment usually justify it on the basis that the cash balance of the policy grows inside the policy tax-free. The argument is that if you don't touch the cash for a long time, say 20 years, you get the growth of the cash value. If you don't collect on the policy, then you can often negotiate flipping the policy into an annuity with the life insurance company. Earlier this year, we did an analysis of annuities from life insurance companies, and we found that the quoted rates of return to be approximately 1%. The yield was better in U.S. Treasury bills. The only reason to put the money with an insurance company is if you have zero financial discipline and can't leave the cash in your own bank account. As an investment vehicle, life insurance policies have very high fees, and these fees are usually much higher than a mutual fund on Wall Street. So if you're horrible at money management, but you can swing paying for your premiums on the long term, then a whole life policy might serve as a means of forced savings, since you'll eventually have the option to tap your policy's cash value. Put it another way, if you don't trust yourself to save money, but you do trust yourself to set up automated billing with your insurance company, then a whole life policy might be a reasonable option. But aside from that one saving grace, whole life insurance is generally not your best bet if your financial goal is to secure affordable life insurance and to invest your money for growth. The rates of return on a life insurance policy, in my view, are incredibly low, and if you withdraw the cash, your cash really cannot be growing in two places at once. First, understand that for any given death benefit, your monthly premium for a whole life policy is going to be a lot higher than for a term life policy. And given that whole life insurance offers perpetual coverage as long as you pay, that might make sense, but it doesn't make it affordable. My personal preference is to buy term life insurance and then make investments separately. True real estate investors have the ability to generate much higher returns than an insurance policy, and the amount of money required to make a solid real estate investment is far beyond the cash value of most life insurance policies. Even if the cash value of your policy was, $50,000, that's a small amount of cash to invest in real estate. There's a fundamental mismatch between the amount of capital in a life insurance policy and the cash required for real estate investing. Saving, as the path to building wealth in real estate, is really the slow train. You won't be able to realistically save fast enough. And if you develop the skill to raise capital, then you can multiply your returns much faster than is possible with savings alone. building investment capital requires a few transactions where you reinvest the proceeds from a capital gain into the next larger investment. So, Dominic, I'm not a fan of the life insurance policy, and I'm not a fan of it as an investment vehicle. So as you think about that, thanks for a great question. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.